Welcome back. Let's talk about Stanley Lifestyles. Now, this was one of the debutants of on Dalal Street this year. The issue price was 369, and it had a pretty good run initially. The stock went on to levels of more than 600 rupees. However, in the last 3 months, as consumption fatigue has set in and consumption growth rates have slowed down, we've seen the stock correct from levels of about 600 now down to 429 rupees. The company has also been expanding. So they opened a hybrid showroom in Kerala. There was also a flagship store that they opened in Tamil Nadu's Coimbatore. So to talk about, the way forward, if growth has picked up, we have with us Sunil Suresh, founder and CMD of Stanley Lifestyle. Sunil, thank you for joining in. The first half was tough. In Q2, your revenues declined by 6%. In H1, it was down over 1%. Have we seen a pickup in Q3? Have you returned to growth? And what could you end the year with in terms of a growth rate?
Yes, I think our order books in December are a lot more positive. We have enjoy about 15 to 16% more order book in December this year compared to beginning of December last year. So I think there has been a definite pickup in the business. However, I think there has been a tremendous delay in project handovers. Our business actually thrives in the tailwind of the housing industry, and there has been a massive delay while a lot of luxury and premium homes were actually sold between 2021 and 2023. The market has been witnessing a lot of delay with more than 1,800 builders across the country delaying the handover of the projects by an average of about 18 months. So I think we are awaiting the handovers, which we hope will start probably from Q4 and early quarters of next year. So there is a lot of order build-up. While customers have been, the traction has been good. Customers are visiting our stores, but not finalizing the orders because they have not got the delivery of their respective homes.
Mr. Suresh, if you could give us an on-ground check. We understand that especially in the state of Karnataka, quite a few new project approvals have seen significant delays, like you just mentioned. So incremental order inflow for you, has it slowed down? And also, as far as FY25 is concerned, will you be delaying or pushing out your guidance to next year?
No, we continue to kind of look for what you call as quality retail for our expansion. We are very mindful unless we get the right locations. We are very mindful and do not want to go and open in areas that are not beneficial to us. We follow RERA. We understand where the housing clusters are coming across all the major cities of India, and then we look for the real estate that is most viable from these areas. So we continue to grow. That is what we have demonstrated over the last 5-10 years, and that is a continual process, and we continue to grow because the demand we see is only going to increase going forward because the number of units sold is already almost doubled from FY19 to FY24.
So sorry, just because on one hand you're saying your order book as of December is up 15-16% year on year, but on the other hand you're saying that a lot of purchases are delayed because the end product from the luxury residential projects have not been handed over to consumers. So where are we? Are we on a growth track? Are we looking at growth in Q3, Q4, second half of the year?
We will more or less have a flat trajectory in terms of how we will complete the year. We have kept our eyes peeled on our profitability. Also, the number of stores that we have added in the last 15-18 months have increased our OPEX. So we are kind of watchful about that. And I think where we are going to witness a lot of growth is going to be next year because, like I said, we have a huge pipeline of customer base that are actually awaiting the handover of their projects. And as that comes into the market, I think the fill-up will start, and we are expecting a very good FY26.
So FY25 will be flat growth, but FY26 you're anticipating a significant growth. So double digit at least?
That's right, exactly.
Double digit at least. Okay. But considering that, the next 6 months are going to be on the slower side, and you've already done a fair amount of store expansion. In the near term, would you be going slow on store expansions? For next year, what would the guidance be?
No, I think we have a plan to actually expand. We were supposed to do about 11 stores this year. As of now, we have very clear visibility of 10 opening. Maybe there is a one store delay because the real estate had some litigation, so that that is the only delay. But next year we have planned to be a little more aggressive. We are targeting about 14 to 15 stores because we have the visibility of the number of projects being handed over. So we want to be in the right markets in the right time.
Okay, Mr. Suresh, just coming down to the bottom line, as far as H1 is concerned, adverse forest movement as well as increased shipping costs is something that impacted your gross margins as well as the EBITDA margins. H2, are we in a better shape there versus H1? Comparatively, which will H2 fare better when it comes to EBITDA margins?
Compared to H1, we are much better in H2. We have kind of already the aging of the stores are slightly maturing. So that is giving us profitability from the new stores. We already had close to almost 40% of new stores below 18 months. But as the months go by, I think the stores are maturing and coming to their optimum yield. So we will see definitely a better profitability in terms of H2.
And break up B2C and B2B kind of growth rate for the next 6 months and even in FY26.
So B2B has been a bit slow.
Sluggish,
Our major buyers are also witnessing a traction drop in their businesses. So we are witnessing a bit of B2B slowdown. However, when you look at even H1, our B2C has significantly grown. Even in H2, I think our B2C will grow by close to 10 to 11% compared to last year H2. B2C is where we are going to propel ourselves more and more, and we have the desired resources now after the IPO, and we are very mindfully, stepping into expansion in various cities where we have not so much of a presence compared to our hometown in Bangalore.
Okay, thank you so much for joining us, Mr. Suresh, giving us a sense of how the on-ground demand trends as well as your own store openings are panning out, and wish you a very happy 2025 as well.